These and all other managerial accounting problems can be found in Sarai's studies. The link is in the description box below. The following data relates to Sarai's company for the year 2021. So we have a bunch of costs and we're asked, what is the finished goods accounts balance at the end of the year? Keep in mind that balance and ending inventory are not the same. So I'll show you. We're going to pull up our inventory accounts. So remember, there is a direct materials account, there's a work in process account, and there's a finished goods account. These are our inventory accounts. But then we also have the cost of goods sold account. I always like to add it at the end. Every inventory account has a beginning inventory and an ending inventory. Because cost of goods sold is not an inventory account, it has a beginning balance and an ending balance. Every account has something that increases it and something that decreases it. For direct materials, purchases of more materials is going to increase the account. Usage of that material decreases that account. The usage of direct materials goes into the work in process account as direct materials because you're in the process of using that amount worth of direct materials, along with direct labor and overhead. What decreases the work in process account is the cost of goods no longer in the process of being made. So that is the cost of goods that were made or manufactured or produced. Cost of goods manufacturing goes into finished goods because if you are done with the goods, then they are finished and therefore is a finished good. So this becomes cost of goods available for sale now, or as the Hay calls it, gas. What decreases the finished goods account is goods that you no longer have because you sold them. So cost of goods sold, and that goes into the cost of the goods sold account. So let's plug in what we have. So beginning inventory, because January of the work in process account is 50,000. Work in process ending inventory, because December is 60,000. Direct materials used is 40,000. Total manufacturing costs, pull up the chart. So total manufacturing costs are made up of direct materials, direct labor, and manufacturing overhead, or just overhead. We're told that total manufacturing cost is $72,000. We have that direct materials used is $40,000, and excuse me, you should have probably put that in there because these two numbers are always the same. Direct labor, we're not given, but we're given $20,000 in manufacturing overhead. So if we know that these three numbers have to add up to this, then just do this minus this to find the remaining, which is direct labor. That's going to be $12,000. So we have our numbers, $12,000 and $20,000. We could have just done 50,000 plus 72,000, but just to show you where these numbers come from, and maybe one question they would have asked you how much was direct labor, then you would have had to do this. But essentially 50,000 plus 72,000, which is this, is 122,000. Debits and credits have to balance, so this side has to be the same. 122,000 minus 60,000 is 62,000. This number is always the same. Beginning inventory for finished goods is 20,000. Ending inventory for finished goods is 32,000. Add up the debits, so we have 62,000 plus 20,000, that's 82,000. Debits and credits must balance, so this also has to be 82,000. 82,000 minus 32,000 is 50,000, and so this number is always this number. But they didn't ask us for anything regarding cost of goods sold, but I just wanted to finish it. But they're asking us, what is the balance? This is the balance. The balance is $82,000. That is not the same as the ending inventory, so don't make that mistake. The finished goods ending inventory is $32,000, but the finished goods accounts balance is $82,000.